Introduction to corporations. If someone invests money in business and manages this business alone, this will usually be referred to as sole proprietorship. If partners invest cash and other assets, such as a building, a truck, etc., into a business, this form of a business is known as a partnership. If an entity or a group of investors decided to establish a corporation, they would apply to authorities to get it registered or incorporated. The authorities would establish the corporation and authorize it to issue a certain number of shares. Sometimes it does not state a limit of authorized shares, so it may be able to issue an unlimited number of shares. The corporation issues shares to investors and gets cash or other assets in return. Let's assume that it is cash for now. Corporation could sell to thousands of investors, hence raising a lot of money as capital. Owning a share allows the shareholders a right to own a part of a corporation's capital. The total shares issued represent the capital of the corporation. One of the advantages of the corporate form of business is the ease of change of ownership or transfer of capital, since shareholders can sell their shares to other investors in a stock exchange. This also makes the life of the corporation theoretically limitless, as it is not contingent on the life of a shareholder or partners. For example, if a shareholder passes away, the shares are transferred to someone else and the corporation itself is not affected. It is only a change of shareholders. If a corporation went bankrupt, shareholders cannot lose more than what they have invested into its shares. This is what is known as limited liability. They also have the right to get the remainder of the assets after paying the liabilities and other preferred shareholders, as will be explained later. Shareholders have the right to vote to take strategic decisions, such as electing the board of directors or raising capital, and also have the right to maintain their proportionate share of ownership in the corporation. That is, if a shareholder owns 30% in a corporation, he or she has the right to acquire 30% of the new capital raised, if and when that may take place. In Canada and in some other countries, common shares could be issued at different classes with the approval of the authorities. Each class has its own rights. For example, Class A's share has 10 votes per share, for example, while Class B has 5 votes per share and Class C has 1 vote per share. A company can produce several classes of shares. Sometimes this is done to protect the original owners and give them more voting power.